Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, December 7th, 2022. It's 12:41 p.m. as I'm starting the video, and I'm going to change gears a little bit in this one and do a longer term outlook of the market. In recent weeks, I've told you I've moved into, well, two things. I've made it very clear that I'm not a big fan of trading actively or big positions between Thanksgiving and New Year's holiday season. Just again, I can't recommend for you what to do or tell you what to do. I can tell you what I'm doing, and I like to keep it light. Now, with that being said, I'm going to continue to share trade ideas, and when I see an opportunity, I'll take it. I've just cut back on my trading and also on the position sizing. Just again, I find it to be a usually more difficult trading environment, especially for swing trading and trend trading. But with that being said, I'm going to just start out just to knock off an update here on that short-term trade that I threw out this morning. I posted in the comment section below this post. I did an update on this, sharing this chart and a level that I missed. It's not a huge level, but I missed it in the first post out to you, and it was right here at about 11,596.50. We'll call that 11,600 on NQ. You see, if I pull the line here, especially most recently, you had reactions on that level, and again, it's something I missed earlier, and so we had a sharp pop at the open, rallied right into that level, and we got checked. Now, with that being said, the basis or premise for the trade is still very much intact. In not just this 15-minute positive divergence here on this chart, but also, which I'll show you in a second, where we're at on QQQ key support. So what I said in there, I think we need to go up, and I think we will. But that, if you want to wait to add on or take the trade altogether, a pop above 11,600 should do the trick. Shoot us up there. There's the first resistance after that, 11,640, about 647. Then the downtrend line in that 11,745-ish level, which I'm targeting. And I still suspect that'll be hit. This is a trade I'm in, and I think it'll pan out. But well, we'll see. Like anything, it either does or doesn't. I had one yesterday that didn't in short-term trade, and that's what stops are all about. And then, of course, that's just a short-term chart. This is the big picture here. 280 is big resistance. It has been for a while, all year, but more importantly, recently, it's this little box here, this trading range, and that's TA 101. Doesn't always work out, but when you recognize a trading range, you go long at the bottom of the range and or cover any shorts if you short it down, and then you swing it up. Now, in this case, I'm not shooting for the top. At most, I think the downtrend line we already got rejected off of, but of course, anything's possible. As a swing trader, you can take a shot there, or even an investor, long-term trader. If you believe this was a bottom in the bear market, which I'm going to talk on in a second, the rest of this video. So far, you have higher highs right here, since that, and 3 higher distinct lows, and so you buy there, and with a stop somewhat above, and you let it run. Remember, the Fed's coming up next week on Wednesday, so you're going to have some volatility. And again, it's been my experience the week or so heading in, especially the few days heading into an FOMC meeting, the markets kind of usually go into a holding period. I think, I told you before last week I expected a slightly downward drift or a downward bias into the meeting, and I think that's what we had. I think there was the profit taking, nervous profit taking, and I think that's probably it. Of course, we had the big breakdowns yesterday, but again, I've said it before, take everything with a little bit of a grain of salt here in the month of December and a week before a big FOMC meeting. So that's that. There's your update on the short-term trade targets, where I think we're going. And now what we're going to do is change gears. And I'm only going to stick on one time frame, and here's how we're going to do this. I'm going to start out with QQQ, the Nasdaq 100, and then I'm going to show you the S&P 500. Again, when I say long-term, monthly is typically the longest time period chart I'll go to. They have quarterly charts that every candlestick is a quarter, 3 months. They have yearly charts, semi-annual, whatever you want. But this is usually the longest term I'll go to here, and gives us the biggest picture. And what prompted me to do this, I replied to several questions on the post I put out earlier today. Somebody asked something about gold stocks, or one in particular I give a chart, and somebody asked about Amazon, which I'm going to get to in this video only because it's part of the top holdings in the S&P 500 and Nasdaq 100. And on that, my thoughts, you can check out that reply as they were looking to position because we're at very near long-term support target that I laid out earlier in the year, about 80, around 83, 85. And I said we're close. There's potential divergence forming very close to that level, so you could certainly make a case to buy here, and with a stop somewhat below for a long-term trade. But by just about all metrics that I have, the bear market's not over. And I also think this one's going to be a lot different from bear markets of yesteryear, and what I mean by that, in recent years. I think this one's going to, the parallels you'd have to draw would be going back to at least the one in the 70s, early 70s, late 60s into the early 70s, a longer term bear market with plenty of bull market, smaller bull markets within it. And therefore, that question was, for college funds, things like that. Well, Amazon may bounce here and probably will. I mean, we already actually came very close already. We reversed right above that level already, and we already had a nice bounce, but bounced back right to resistance. And again, I don't know. Let me do this video, and then you guys can decide whether what you want, how you want to formulate your long-term outlook, because that's what this is all about. If you're looking to start accumulating your favorite stocks for long-term, for retirement, in anticipation that the bear market either has ended or maybe we have just one more thrust down, make a new low, and then that'll be it. Well, let me show you this chart. And again, these stocks you can watch. You can reference this later on. We'll see how it plays out. So I'm going to go back to the monthly charts. And we'll start out here with, well, let me go to QQQ, and then we'll go to SPY, and then the top holdings in the S&P 500. So we'll roll back here. Remember, the Nasdaq hasn't been around as long as the S&P 500. But let's just study the current, what I consider the current primary bull market uptrend line. Again, there's been, technically some bear markets or drops of over 20% since the last real bear market ended. To me, the last real bear market was 2008. I'm sorry, 07. That was October of 07 into the end of early 09, March of 09. And that was a 55% drop in both, roughly 55% in both the S&P 500 and Nasdaq 100. And then we embarked on one of the biggest, if not the biggest, strongest bull markets in history, a la, we'll call it the Fed market. This was the Fed bubble. This is when quantitative easing and zero interest rate policy and all the easy money began, and they kept the pedal on the metal all along. They tried to take it away a couple times. The market threw a fit, like back in the fourth quarter of 2018 when they started to try to take away the easy money and tighten. And as predicted at the time, market threw a hissy fit, and as predicted at the time as well, the Fed pulled a complete 180 and went back to it. So, and then when COVID hit, I don't have to tell you what happened. That was, we were already in the easiest money period in history from the Fed, and then COVID hit, and they just went all out bananas. It's like Fed gone wild, overdid it. Washington overdid, and that's what gave us, when you turn off all these lines, this last kind of a blow off top, just similar to what we had in when the dot-com bubble popped in March of 2000. That last leg up was super strong, and so this was from excessive easy money policies and stimulus from the federal government, despite the economy that was very resilient. We had shutdowns, but everything underpinning demand and everything was good, and so we know what happened. So let's just look at the technicals. So I have a trend line. I have multiple trend lines here, including this one that got us short on this bear market right there when we broke right here at the highs. But this is the primary one. It comes off the bottom. The Nasdaq, unlike all the other indexes, which technically bottomed in early March of 2009, the Nasdaq had hit its bottom in October of 08. And then put in almost an equal low, but a slightly higher one. So that's where I have that line drawn. So you can see when you zoom in here, you come and you catch these periods. We're call them corrections, call them mini quick bear markets like COVID, 31% drop. You can see these candles close. Look at the candlestick bodies right on that line. When I draw my trend lines, I look for the most number of candlestick bodies, the fat part, or the shadows, the skinny part below. And you can see that trend line was respected here. So COVID, we only had an intramonth break, but we closed the month back above it, kept that bull market solidly intact based on that metric, that line, as well as my favorite, one of my favorite long-term trend indicators, that 20 period exponential moving average on a monthly chart. Just does a phenomenal job of defining bull and bear markets. I've covered it hundreds of times here over the years, and you can see in a bull market you buy pullbacks to it, and as long as you're above it, it tells you you're in a bull market, as you were this whole period here. And then when you're below it, you're in a bear market. Simple stuff, right? Okay, so we are now, by that metric, clearly in a bear market. I pointed that out when we finally had a solid closing base candle below it on the month ending in April. We're below it on S&P, I'll get to in a minute. And I like to use trend lines as well. And so we took out the primary uptrend line as well, and we simply are back testing it. We just back tested it from below last month and this month. And there's that downtrend line we got rejected off. So for me, to what I need to see to start convincing me that this bear market is most likely, maybe this was the end and that I'm wrong, we're not going to get another leg down, well, I'd want to see a solid monthly close above that blue line, the 200-day, I'm sorry, the 20-month exponential moving average. That would also see us regain the primary trend line. It would see us take out this downtrend line. But again, that's a big one right there. We're nowhere near that. And I also have the PPO histogram down here. It's a very simple and effective tool as well to kind of point out the bigger trends. I've covered that in the past many times. When it's red, you are in a bear market, right? Or in at least correction mode in a bull market. It's very simple. And we are solidly red now, nowhere even close to crossing over. So from every metric I see on this chart, we are in a bear market with no signs of a bottom yet. Okay, only time will tell. Maybe we won't get a traditional capitulation type sell-off like most bear markets have. That would be unusual, not impossible, but unusual. And that's that. So all right, let me move forward and I'll go through the rest of these a little bit quicker. And because I'm not, in fact, the majority of stocks, or a lot of stocks, are still above their bull market trend lines. That's what I'm going to show you here. And the takeaway will be, we'll revisit this from time to time. I don't update the monthly charts. I don't do videos on these long-term monthly charts all the time because they don't change that often. It's going to take a while. And the most important thing is how you close the end of the month. So I'll revisit this next time we have a really big up month or a big down month, or just from time to time. So on the S&P 500, we scroll back. Here's our longest term. This is the stock market is and has been in a secular bull market for a very long time. A secular bull market is the longest trend. And within a secular bull market of any security, including the stock market, you have cyclical bull markets and cyclical bear markets. Doesn't look like much, but that one was a 51% drop off the highs. There's your cyclical bull. And that was the 2007 to 09 bear market, 57% drop. And this is just one mega cyclical bull a la the Fed. You can see, typically bull markets don't last that long. You can see the periods here. And this one's, to say it's a little long in the tooth would be a gross understatement. All right. Now, keep in mind, this is, again, our secular bull market uptrend line. And it is, in my opinion, it doesn't have a lot of reaction, so I'm not going to put a super heavy weighting on it. But you can see where it comes in. It comes in at these two bull market highs right here. This whole thing was a breakout right here back in looks like 2013 or so. And that is certainly what I believe to be a potential target, because I do believe this will be a much deeper and much longer bear market than previous bear markets for many reasons. I could probably talk for 45 minutes from a fundamental perspective. One of the top of those being the case I've made before, that interest rates have ended a new secular bear market that goes back over 40 years, falling interest rates, and by just about all metrics I have, including technicals and fundamentals, we are an early stage new bull market. And that in this whole secular bull market here was, make no mistake about it, largely if not exclusively due to the fact we were in a secular bear market and interest rates. Again, I've covered that many times. don't want to get too far off task on this, but if we have seen a bottom, and it's hard to argue. Really, nobody can argue that we haven't seen the bottom in rates because the Fed took it down to zero and kept it there for zero or near zero for years. And so, at best case, we just stay there. But there's no more extra juice to be had, and inflation continues to be an ongoing problem for years to come, as I think it will be. I think you'll see these periods of abatement, market rallies. Those are your bear market rallies. We will trade those. Then inflation will again rear its ugly head. It's that whole vicious cycle, negative feedback loop thing I've talked about recently as well. Okay, so we're going to zoom in nice and tight on the S&P 500. I showed you the Nasdaq 100, and you can see the S&P 500 also right here. You can see it holding. I love that 20-month exponential moving average, holding. Even that month, intra-month break, closed right on it. Look at that, 1, 2, 3, 4 candlestick bodies and/or shadows right on that level, and then boom. This was the month of ending in June, gave up the ghost. After that, what happened? Support, once broken, becomes resistance, back tested, couldn't get above it. Tried the next month on that bear market rally, it got above it intra-month, but failed, got rejected to close right back down on it or below it. Rejected again on the next attempt. Look at all these, 1, 2, 3, 4, 5, 6, 7, 8. That one was below, another test, back tested from below, and another back test, a test of it this month. So that's it. And again, we start moving up there, and you can see resistance here. These are the things that will make it hard to argue that we're still in a bear market once you start to take these levels out. I mean, obviously, if you take out the old highs, and that's going to be a hindsight thing. So I'm going to hopefully identify earlier if this was a bottom, but I'm still not. It still doesn't appear to be, in my opinion. And again, the bigger picture, this is, think 401ks, IRAs, long-term stuff, and also how to formulate your trading. If you have a longer-term bearish bias and you believe you're in a bear market, you want to, as I recently highlighted, start scaling back into shorts on bear market rallies when you run back into resistance levels such as key Fibonacci retracements, key moving averages, price resistance levels, key downtrend lines, everything I've highlighted recently. And so, I hear these people sometimes saying, oh, don't be a bull or bear, just trade the charts. That's hogwash. You've got to have a bias. Otherwise, it's paralysis by analysis. You can always sit there, or I can make at almost any point in time a bullish case on a stock or a commodity and a bearish case. You got to pick a side, to make money. And when you're not sure, look, I'll tell you, when my convictions aren't high, I don't force a trade. I don't, it's not. People ask me my opinion on stocks all the time or the markets. Sometimes I say I don't have a good opinion on you right now, and so I move on. I trade something else until I do have a good opinion on whatever it was I was, asked about. All right, so that's it, and I still think the S&P is coming down here to 328, and that would be a drop of from where we're at today. Zoom in there, we're roughly right here. So the next leg down should take us down about another 17.5%, and there's a good chance that it starts from really where we peaked last week. As I said, I think there's a decent chance, and I have room for more upside if it wants to. All right, so now we're going to go through all the charts, but again, I'm showing the indexes by my long-term trend indicators have broken down and triggered sell signals and remain on those trend indicators, remain bearish. So things change. I'll do an update if and when we do move up. And if we get rejected here soon, that's going to help to validate those levels. And keep in mind too, the next leg down, when it finally starts to build momentum, we start to take out more and more of the previous support levels, it should build steam or build momentum, and probably be a quick swoon down to the next target at some point. Probably going to be after the Fed at least, but we'll see. Okay, all right, now I have a lot of stocks to go through, so I'm just going to go through those quickly. Apple, I'm going to spend a little more time on these top components because they have the biggest weighting in the S&P 500 and the Nasdaq 100. But here's my long-term chart of Apple. I've shared it many times. This 30-year chart highlights all the cyclical bull and bear market tops and bottoms, as well as the primary uptrend lines which defined each bull market. The percentage of each drop was calculated from the previous bull market peak to the bear market trough, which are the arrows. So this is the history of Apple since the company came public back in the early 80s. And so I've measured out all the bear markets. I'm going to read them out to you real quick, or all the big ones. 59% drop, 70, 74, 83, 42, 62, 45. That was 34 before all said and done, 39. And then what I noted here, Apple bottomed so far back on June 30th. And so you can see here only 29%. That's what I did back here on the site. Back here, I expected more downside. So when I made a post, I put that in there. Only a 32% drop with a question mark, meaning based on the chart pattern, I thought there was a lot more to come. And it certainly was, especially in time. Not so much in percentage term, but the bulls that gobbled that reversal up. There was a big drop and a reversal. It's still there was a lot more downside to come. And remember, these are monthly candles. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 9 or about 9 more months after that drop there. So you would have not wanted to be long Apple, or you would have probably thrown your position away, and you would have certainly gone underwater having bought it there, thinking the end was over. So that's what I put here, 29% based on what I just read out, all the other bear markets. And keep in mind, this I can make a more bearish case now by far for a much bigger drop than I could on those other ones. Why? Because we had much larger, we had divergence on both indicators. And so here's all that has to happen. There's the uptrend line right now, my current uptrend line on Apple. Comes off the lows in early 2019. Another reaction there. And you can see Apple flirting with that 20-month moving average. Hasn't taken it out yet, at least not on a solid monthly basis, and it's got nice price support. So to me, lights out on Apple on a monthly close below 134.50 right there. Call it 134 if you want. You're going to take out the 20-month moving average. You're going to take out the uptrend line. You're going to take out this beautiful support level right here. And where does it go? Well, there's a reaction here. I'm sure they'll step in and buy, but you're going to come down to this yellow larger uptrend line that I have here, and that's and that would put us more in line with minimum what the charts are projecting, in my opinion. And that would be about a 59% drop from the highs. I know that's heresy among Apple bulls, but for years I've called those kind of drops, and most people just can't fathom, NVIDIA going down, 60, 70% like I called for, and Apple and these big companies. Apple's not going to drop as much, but that's where it's going. And again, the bottom line, by every metric, I have this bear market on Apple has only started, just begun, and we haven't even seen, real phase of selling in there. So that's that. Let's move on to the rest. We'll go a little quicker as we move on here. This is Microsoft. Again, you can see the history of Microsoft since it came public back there in the 80s. There was your first uptrend line. And, and the takeaway from this too, guys, is that technical analysis works every bit as well and almost the same as on these long-term monthly charts. This is the realm of the investor and the trend trader. This is your retirement, 401k, when to buy Apple, when to get out, or Microsoft, whatever. And same thing, you had a divergent high. You had a minor trend line break first. Took out the 20-month moving average, and then you were in a bear market. It doesn't look like much, but that was a big drop in Microsoft. I'm sorry, split adjusted. It's $52, dropped all the way down to what is that, 15? So it got cut in almost over a third, 2/3. And you can see once it broke that 20-month, look at this. It just did a perfect job of defining that uptrend. Broke it here. Stay below it, and every time it tried to rally back, it couldn't. But it did. It took it right here. You could see that zoom in real tight. It took it back, and then it danced on top of it at a little whipsaw. It was more in a trading range. Microsoft was dead money for years. Some stocks, don't always do this. Then it started a nice cleanup trend. So here's where we are, Mr. Softy. We have the uptrend line right there. That is my primary trend line. This is where I believe we are going before all is said and done. It may take a little while to get there, or it may come faster than most think. Either way, I have high convictions that this is where we're going in Microsoft. Again, I know, most folks would laugh that off. That's another 47% drop, but it's priced in the charts to me. And that's on top of the drop we've already had from high to low, roughly 40%. So all said and done, that's a call of a drop of 60 something percent, a good 60% Microsoft. And let me zoom in nice and tight. So remember, that was my primary uptrend line. This is the the minor uptrend line, but a very significant one. It goes back to 2015 right here, and it has a lot of clean reactions by that. That's what I'm talking about. All these reactions on it. It was support. That's where the buyer stepped in there. So what happened here? 20-month, it was testing, broke the 20-month right here. It's been trading below, and we remain below the 20-month moving average as well as that trend line. So by every metric I see on this chart, this one's in a bear market, and it's still an objective short for a long-term position to go down here. Just again, you don't use, or I don't use the monthly charts as a timing indicator. You know, you use the 60 minutes and the dailies to kind of hone your entries and exits. This is just painting the bigger picture. So when does that bigger picture change for the better? Well, you take back the 20-month on a solid closing basis, especially 2 months above it. You know, the farther you can put it in the rearview mirror, the more bullish that is. And also if you could recover this trend line right here as well. So, you know, if we have a rally after the Fed, you might see something like this. Let me give you a little scenario. Maybe you run up intra-month. There's a Santa rally. Santa finally comes and gives us that Santa Claus rally so many are clamoring for. You run up, back test the trend line, only to get rejected and close back again down below the 20-month moving average. Again, all that matters is how you close at the end of the month, not what happens intra-month when you're analyzing off this time frame. Picking up speed. Alphabet's still up. I have a primary trend line, which is the one I give the highest weighting to, and a BOD trend line, a benefit of the doubt. So the benefit of the doubt, they're both important. The benefit of the doubt, as the name implies, there's my primary trend line. You have more reactions on that one. That one cracked, and we're trading just hair below, but not below it enough to say that it's been taken out. We're right on it. So at this point, I need to focus on my BOD, or benefit of the doubt trend line. That means I come in and connect the lowest points I can, and there's 3 distinct reactions. You know, starting back here, came close there, but a little bit above it, but back here, and COVID hit, tested it, and then again recently. So when that goes, if and when that goes, lights out. But as you note here, or as you can see, there's the old 20-month support. Even when COVID hit, kept it on a monthly closing basis, but boom, lights out. Right there was our sell signals, closed below it. And since then, every single month, for at least a few months, it tried to get above it, got rejected, smacked down each month, and now it's walked away from that level. So bearish, longer-term bearish. Amazon. Okay, that's what somebody asked about today, and you know, for college funds, all that. Well, you know, I make the case it's certainly an objective long at that support on the weekly, but here's my BOD, or benefit of the doubt trend line. This again, I'm using, these are since these stocks came public, and these are the leaders, today's leaders. 1, 2, 3, and we had several reactions there. So this is a very valid trend line. It's a bull market, primary bull market uptrend line. I had a secondary trend line right here off the same level. You can see it's that yellow trend line. Both have been broken. The yellow trend line has a few more reactions, but we hit, this is my primary, or BOD. We hit it there, we bounced after taking out that 20-month. Look at that big red candle, rejection on the back test, and rolling over. And so again, big picture, this is Amazon. I mean, how do you not love Amazon? My goodness, every day I have somebody knocking on the door. I work from home, so this is where I do most of my shopping. You gotta love them. But the charts are the charts. You know, and there's things when a company gets so big, and we're seeing it now, rising fuel costs. You know, Amazon got their own fleet of delivery vehicles. They kind of got out from under the thumb of FedEx or UPS, whoever they were using before, and now you're hearing all these, you know, all this clamoring about unionizing and all this stuff, and wage pressures and all that, and you know, and competitiveness. Walmart, a lot of these other retailers are really kind of coming on, starting to give them some real run for their money on online sales. And so, you know, again, Amazon's still going to be a great company, but the technicals say, and there's a little level, and that's that same level I just gave you earlier on the weekly, 83.50. If that goes, and based on this chart, when I look at the scope of these divergences and everything I just talked about here, primary secular bull market, not cyclical. You want to get these cyclical bear markets, they don't last. The secular bull market will not last forever, and so each time you had a cyclical bear market, that brought you back to that level. Except this time around, it was a good time to buy. This time around, you broke it. So this is probably going to start a much longer, prolonged bear market in Amazon that will probably last years, in my opinion. Yeah, and there'll be plenty of rallies along the way. Alphabet, I already covered. I already covered the other share class, Class A. This is just the Class C. I believe that's what it is. There's your trend line. So that one needs to break. So we are below the 20-month. Like I said, rejected, clearly below it. When we break this, that's not good. No bueno. But we haven't. And that's the takeaway from this video. So we've seen quite a few of these, some of these leaders break, but a lot of these are still clinging to some very significant trend lines. So you can't completely write it off. In other words, my conviction is not the utmost highest that we're going to have that horrible bear market. Now we could bounce and have another run up and even new highs, and then come on maybe a couple years from now and take out these trend lines. They'll still be every bit as valid then if that happened, even more so, because you'd have extra validation, another test here. But again, based on a lot of factors, I think they're going to break sooner than later. And the takeaway is, if they do, you need to kind of shift your paradigm of thinking away from what just about everybody on TV and financial advisors. I used to do that for a living, and it's all about time in the market, not timing the market. Stocks go up. As we haven't seen a Japan like. Again, I've referenced the lost decade in Japan, which was really 2 lost decades, and do the research on what happened and how, and the similarities between their economy and ours leading up to their debt bubble and real estate bubble collapse, and then their zero interest rate policy and everything else, and how long it took the Nikkei to get back to where it was. So you're talking decades of underperformance. So again, just showing you the levels to watch. Tesla. Yep, looks like it peaked out here. Hard to argue. We had a big divergent high, negative divergence right there, and it took out this pretty important about 205 support. It's already taken out the 20-month right there. It's a relatively new company, so you don't have a lot of trending history. And most of this period here was chopping around a sideways range, so that's where these trend indicators don't work well. They work well in a pure, clean uptrend or a clean downtrend. But either way, probably headed a lot lower, and it's a big thin zone down here. So I don't know. I don't know if that one's going to 27, but I can certainly see the possibility there. UNH. So here's what needs to break. So you've heard about how, and I've talked about it, how the Dow and the S&P has outperformed on a relative basis against the tech-heavy Nasdaq. What needs to break to really get this bear market underway are a lot of the blue chips and other sectors that haven't. Healthcare is a big one of them. So again, remember, I'm going through the components of the S&P 500 in descending order of weighting. This is UNH, United Health Group. And you can see, it has these trends. We're going uptrends, bull markets. It's been a strong stock. Its correction in for decades now, it's only mostly corrected in time. I always say there's 2 ways a stock or an index can correct: in time or price, or a combination thereof. And then, in this case, it went down a little, but it was a mostly correction in price. Next leg up, bull market. There was a correction this was a correction in time, bull market. This was a correction in price, bull market. And there's my primary bull market trend line. It was taken out here at a point that I refer to, well, that was when COVID hit. Right there, it still went down, made a new low in what I refer to as Ursa interruptus, my term for a interrupted bear market. The Fed refused to allow. Economy really should have had a purge out at that point. Stocks have gotten so far ahead, and recessions are actually good for the economy, just like, prescribed burns for the forest. You burn away, that undergrowth, and then doesn't, prevents that big 100-year fire that burns all the old trees and everything down with it. And that's what's, pretty much the Fed is creating in this environment by continuing excessive support in the economy and refusing to allow bear markets or recessions. Well, not bear markets, not so much, but recessions. Anywho, so there was another correction in time, and this is the most recent trend line right here. You have this minor trend line right there, but remember, we've already broken. This was a very significant trend line, and we broke it, and we just back tested it from below. And so when the minor trend line goes, and that 20-month moving average, this one has a lot of downside. These are my targets if you wanted to short this individual one. Each and every one of these marked levels. And before all said and done, this super new bear market coming up. And again, it's going to take probably a couple of years to get there. That's a huge, I know that's a huge target, but this is, where I could see it going down. And here, let's just play a game here. It's probably going to take me forever, this video now, but let's just put up Fibonacci retracements and see if that target is so unreasonable. It's $543 stock right now, and I'm calling it down to $60 right there, $57. It would be let's see, retracement wise. If I put on the 76.8, where does that come in? Well, that's going to come in. Okay, so you know what? I'm changing my tune. All right, so that's certainly a big level, but this is and look, I've never put these fibs up on the monthly before. I just kind of pulled them up real quick. I didn't even zero them in exactly, and you can see where they come. Maybe you can't. This is the 50. This top line here is the 38.2. This 50 comes right on my first target of 289.50, right on it. It overlaps. The 61.8, pretty much right on my 211.50 target. And then that 78.6 I just added right there on that 126 target. So let me just say that this is my very highly likely bear market target, 211.51. That's calling for a drop from the stock, and this one's near all-time highs. This is where you get more meat for your, or more bang for your buck, I think, now than a lot of the big tech. Shorting some of these that haven't yet broken. That's a 60% drop, and we'll just call this my maximum bear market target right now, and that'd be a 76% drop. But even a 60% drop, it's going to take the stock market down quite a bit if we get there. All right, let's move on a little faster. J&J still above trend, another healthcare stock. Big divergences building. Hasn't broken down yet. ExxonMobil, at least on the monthly, hasn't broken down yet, but look at the steep uptrend line, and you guys know we're short energy right now via XLE or whatever the leverage shorts, whichever ones you took, if you took any of those. Visa is there. It is. Look at this stock. Came public back here in early '08. It has a nice, very nice, clean, well-defined uptrend line, which it broke. It is correcting mostly in time. It's been a pretty decent price correction, but relative to the previous move, it's mostly correction in time, and it needs to take out 185. And if it does, the stock's probably headed quite a bit lower. I don't have any targets for you on that one. NVIDIA. I've already shared this one. I had targets on the weekly chart, which were just hits, played out like a fiddle. Called it down to where it was right there, and I still have additional targets. And NVIDIA has a history of big price corrections. And look, that one's at 78.6 fib is at my next, and at now, let's just say my final bear market target around $74. So remember, I gave this one to you on the weekly, and there's the weekly chart. We hit T2. T3, let's just say right now, 73 here. Let's just say at this point in time, it's a likely target, and this is still a potential target, that longer-term uptrend line I've showed you before, T4, and there's that long-term uptrend line. Walmart is yet to break. There we go, right there. Primary uptrend line. Zoom in. It's really back test. It did break, and it's back testing right now. Big divergence, negative divergence, and Walmart at minimum's coming down to this uptrend line, I believe. So quite a bit more downside to come in Walmart. JP Morgan, here's your uptrend line right there. And again, this is just a quick overview on the longest term charts, but you can see big divergence building, negative divergence, and that would indicate a trend change. It's going to be measured in most likely years, not months, and probably take JP Morgan down to this 55-ish level right there is my guess. And of course, you want to see this trend line go. PG, Procter & Gamble, that one broke the uptrend line, but hit that 126 support. Needs to take that out. When 126 is taken out, I'm going to give you one more level here. It's going to go down to 94 roughly. I put very good odds on that. So you can set a price alert, pretty much shorted a break of the recent lows, and that's going to give you a swing down for about a 20 something odd percent gain. And again, the takeaway, the importance. These are the bluest of blue chips right here. We're going through the S&P 500, and so this is what needs to happen. And based on my analysis of the charts, I think it will happen. You can see last time we had a week, or I have at least on the monthly chart, divergent high was right here, and the stock dropped. Let me measure it because it was from that point down to this point. Pop-up box on the left tells me that was a 55% drop there. So right now I'm calling for from the highs to my target, minimum bear market target, about a 45% drop. That's in line. Lily, ooh, look at that big bearish rising wedge. Needs to break that, and I don't know if it's going to come all the way back to 109, but certainly going to go down. And again, I'm showing you so you can see as I go through these components what's held up, what's been strong. We all know that energy has been one of the best performing sectors. Energy and healthcare, really. So those two need to break, and I believe they will. MA, MasterCard, just like Visa, it's flirting on support. It's got support around 310. Needs to take that out. Meta, well, we know Meta's already died. It's just annihilated. And again, this was one of the largest companies in the world at one time. And it's down 76%. And I pointed out recently it was a objective short on a back test of this 123 level. I think I gave that on the weekly or the daily. Yeah, there it is on the weekly. That was nice support. Drop below, boom, hit it. Remains, well, I already had a nice pullback off that level, but let's get back on task here. Where am I at? 41 minutes. Oof. All right, Home Depot, not yet broken, needs to break 264, and then that blue trend line, and then that's going to be pretty bearish. That's obviously a stock market bellwether right there, dancing on that 264 support. ABV, ABBV, I don't have the chart marked up. It's kind of messy. Pfizer right there broke this trend line, back tested, and kind of needs to really take out 44 on a monthly closing basis. See that intramonth stick save? That's the number. You see that one close a month below 44. Lights out for Pfizer. Merck, again, healthcare sector's been strong. These pharmas. Merck at all-time highs, but big negative divergence on Merck. Last time we had divergence of that scope was back here in the 90s. See that? Right there. Look at that beautiful negative divergence right there. And how much did the stock drop? I have to do this when the, well, I can turn off the lines and then grab it at the top. Same difference. All right, so the last time this blue chip pharmaceutical company was put in a comparable divergence on the monthly chart, it fell 78%. So that's it, guys. These are, I don't guarantee that these stocks have to fall this much, but it's what I see right now. And if I saw it any otherwise, any differently, I would tell you. Bank America, last big divergent high was right there. And there we are. There's your uptrend line right there. We already were rolling off that divergent high. Doesn't look good. KO, Coca-Cola, Pepsi. Here's my longest term uptrend line. Comes all the way back here in the 80s, and this is another one that's held up, but look at this. See these divergences here on the stocks that haven't yet broken. Remember, the ones that have broken, like the FANGs, the big tech, they had these divergence highs. They're already started. They're well into their bear market as far as it drops off the highs. The ones that haven't broken, this is what the market will come after next. Once the leaders die, Apple, Facebook, or Meta, Amazon, then the rest of the market will slowly die. It doesn't usually one sector rolls over. It's usually tech. Tech leads the way up, leads the bull market, outperforms on the upside, and then when tech dies, ultimately they're going to come out and they're going to find these other companies, and they're one by one they're going to get or sectors they're going to get targeted. So this is what you want to watch for. And once the majority of these blue chips that I've showed you here break, like TMO, Thermo Fisher, there's a beautiful uptrend line. Costco, oh, everyone loves Costco. This is one of Charlie Munger's favorite stocks. I respect Munger, and from a fundamental perspective, it's great. I spend a lot of money at Costco. I'm sure a lot of you do as well. But you've got the divergent high right there, minor trend line here, and the 20-month moving average. We're just sitting right on them. Once they break, that's going to take us down to the primary bull market uptrend line. So there's your short target. If you wanted to let's just say today, roll the dice, even before the Fed, for and you shorted Costco today, if you're willing to ride it out, give yourself a nice 2 to 1 or maybe 3 to 1 RR risk reward on your stop. It's going to drop, I think, another 25% or so to this primary uptrend line, and that's where I'd be a buyer too. This is where when if and when I'm right, and these stocks break down, they haven't. Like I said, a lot of leaders and blue chips haven't broken down yet. Not from this perspective, this time frame. When they do, I'll be watching closely to see, and this is how it works. The majority of those will come into these targets I gave you around the same time, and that's where we're going to look to cover shorts. You won't want to go long and cover shorts then. You'll be wanting to short, most of you, just from experience. But those are the points where I'm usually closing out shorts and starting to go long when everyone else is, puking up their longs. And again, it's all comes in together. I'll look at the SPY, the S&P 500. I'll look at Treasury bond yields. I'll look at the the dollar, and again, mostly the market leading stocks, because they all tend to move together. Broadcom, Oracle. So you can see some of those are above trend. Cisco, big nice trend line there. Big divergent high, says that this correction, that's only the first wave down off that divergent high most likely. And kickback rally, and it'll break ultimately. McDonald's, this one hasn't broken yet, at least not on the monthly. Had a break here, but remember, this was all, and a lot of stocks had these corrections in time. There was several. That was, look how many years that was. It broke the trend line right there in the rising wedge, and it corrected for, what is that, 4 years, 5 years? And remember that whole period was in one of the strongest secular bull markets in history. So it's, that's why you had that sideways correction instead of a big down like the previous bear market right there. And this time around, absolutely, I expect McDonald's to come on down once that trend line's broken. There it is. So you can see as I go through these, I'm going to stop here at next one, T-Mobile. This is ACN, Accenture. There's your uptrend line right there. It needs to break. And T-Mobile, look at that beautiful uptrend line right there. So comes off the lows, captures that drop right there when COVID hit, and we've been dancing on it right there while we've been making the first divergent high really in pretty much since this one came public back here. Yeah, so all right, guys, so I'm going to wrap it up here. Long video, but and again, not exact timing indicators here, just kind of stuff to keep an eye on as we move forward. Whether these charts firm up by a lot of these stocks, holding and bouncing off these support levels, and more importantly, for those that have already broken down, did they recover the 20-month moving average? Did they recover the trend lines that they've broken, or do the rest of these stocks, which I suspect, start to break these support levels? And if they do, there'll be a point where the downtrend starts to snowball once it becomes apparent to all, once these key support levels break. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.